Dear students, as we have completed the financial statement part 1. So in the financial statement part 1, we have learned how to prepare the financial statement, that is how to prepare the trading and profit and loss account and how to prepare the balance sheet. We prepared the trading and profit and loss account and balance sheet without any adjustments, in the sense after completion of the books of accounts for the particular year, some of the items were not entered into the books of accounts. So the items which are not entered into the books of accounts, they are called as adjustments. But in financial statement part 1, we haven't considered and we haven't taken into account because of the learning easiness. But now, since we are in the financial statement part 2, we have to comply with the adjustments. Some of the adjustments are there. They need to take into account after completion of the books of accounts for a particular period and while preparation of the financial statement. Some of the items are, the first one is a closing stock. So how to consider the closing stock and how to treat the closing stock and what journal entry we have to pass while preparing the financial statement and where we need to record, whether we need to record in a trading account or we need to record in a balance sheet. So that one we have to see. So first one, closing stock. So for recording the closing stock, we have to pass a journal entry, closing stock account data to a trading account. Closing stock account data to trading account. After passing the journal entry, that will comes into the trading account. So now where we have to record this closing stock, either in a trading account or in balance sheet. Obviously, we need to record the closing stock both the places, in a trading account as well as in the balance sheet. So in a trading account, we have to record in the credit side, and in a balance sheet, we have to record as an asset in the asset side. The closing stock is an current assets, it will comes under the head current assets under a balance sheet. So the next one is outstanding expenses. Outstanding expenses means the expenses which is related to the current year but not yet paid, or the expenses is due on the last day of the accounting year. Such expenses are called as outstanding expenses. Example, the salary. The salary of the March month will not be paid on 31st of March, but the salary will be paid on 5th or 6th or 10th of April. But that need to be accounted in the accounting year itself. So such expenses are called as outstanding expenses. Now what journal entry we need to pass for recording the outstanding expenses in a books of accounts and where we need to record it in the financial statement. The journal entry is expenses account. Expenses account means the concerned expenses account. Which expenses it is belong. If it is a salary, then salary account debtor. If it is a rent, then rent account debtor. That means expenses account should be debited. 2. Outstanding expenses. Outstanding expenses means outstanding salary account or so outstanding rent account. So that journal entry we have to pass. And in the financial statement, where to record? In trading account, as we have seen already, all indirect expenses will appear in the debit side of a profit and loss account. So therefore the expenses will appear in debit side of either in the trading account or in the profit and loss account. If the expenses is wages, if it is outstanding, wages is a direct expenses that will appear in the trading account. If it is a salary, that is the indirect expenses that will appear in profit and loss account. See now, so in a trading account, we need to add the wages, outstanding wages to the wages account, and in a profit and loss account, we need to add outstanding salary to the salary account in the debit side. That means trading and profit and loss account in the debit side we have to record. And in the balance sheet, since the outstanding expenses is obligation to the business for the current accounting year but not yet discharged, till the date it not yet discharged, it becomes a liability. So therefore it should be shown in the balance sheet under the liability side. Next, prepaid or unexpired expenses. So opposite to the outstanding expenses, prepaid means the expenses which is related to the subsequent year but it is paid in the current year itself. That means the expenses which is related to the next year, but it is already paid in the current year itself. As per this accrual system, we are not supposed to record the expenses paid which is related to the next year in the current accounting year. So therefore, what journal entry we need to pass is prepaid expenses account. That means the concerned prepaid expenses account data are to the concerned expenses. Salary prepaid data are to salary account, or rent prepaid account data are to rent account. So that journal entry we need to pass. And in the trading and profit and loss account, what we should do is, in the debit side of trading and profit and loss account, we need to subtract the prepaid expenses account from the concerned expenses account. And in the balance sheet, so we have to show under the assets side, because the expenses prepaid or unexpired expenses is an asset. So therefore, that should be recorded in the balance sheet under the asset side. Next, the income earned but not received, or accrued income we can also call it as income earned but not received, or accrued income. So income is generated, income is accrued, income is due but not yet received. It is called as accrued income. So we need to bring into the account by passing the journal entry accrued income account data are. So which income? It may be interest accrued, or it may be the commission accrued. So that interest account data, accrued interest account data are to interest account we have to pass the journal entry. And so this should appear in the trading and profit and loss account, and as well as in the balance sheet also. In the trading and profit and loss account, we have to record it in the credit side, and in the balance sheet we have to show it as an asset. Next, income received in advance, on the contrary to the earlier explanation. So in the earlier explanation it was accrued income, but here in this case income received in advance. Actually the income is pertained, or the income is related to the next year or subsequent year, but it is already received in during this year itself. Such incomes are called as income received in advance. And generally we can understand that if it is not belongs to this year, it is belongs to the next year, but if we received in this year itself, it becomes a liability for us. That means liability for the business. So therefore we need to pass a journal entry for that, and we have to record it in trading and profit and loss account and in balance sheet also. So the journal entry for recording income received in advance is income account data. So which income? So commission account. If it is a commission, commission account data. 2, commission received in advance account. So that journal entry we have to pass, and we have to record it in a trading and profit and loss account also. In the credit side of a trading and profit and loss account, from that income we have to subtract it, and in the balance sheet once again it becomes a liability, and we have to record it in the liability side of the balance sheet. Next, the very prominent item is depreciation. So in a subsequent classes you people will learn a separate chapter called a depreciation. I will explain you in a very simple words. Depreciation means the gradual or the slow decrease in the value of fixed assets. Almost all the fixed assets except the land are depreciable assets. So because of the use, because of the wear and tear, because of changes in technology, the fixed assets will lose its value gradually, slowly. So that slow or gradual decrease in the value of assets is called as a depreciation. So the depreciation is an expenditure to the business, and we have to record the depreciation in a books of accounts, in profit and loss account, as well as in the balance sheet. So the journal entry for recording a depreciation is depreciation account data to concerned assets account. On which assets we charge a depreciation? If we charge a depreciation on building, we have to pass the journal entry depreciation account data to building account. If we charge a depreciation on furniture, we have to pass a journal entry depreciation account data to furniture account. And the amount of a depreciation, how much we have calculated. And as I said already, in the subsequent classes you will study the different methods for calculation of a depreciation, different methods of calculation of a depreciation. But now only we should learn, so what journal entry we have to pass, a depreciation account data to concerned assets account, and where to record them. So first we have to record it in the trading and profit and loss account in the debit side, and afterwards in the balance sheet from that concerned asset we have to subtract in the assets side. This is depreciation. Now let us move on for the one more little bit a complicated item. So that is provision for bad and doubtful debts. So in the previous classes, that means in the financial statement part 1, I have explained to you what is debtors. So debtors means it is an asset to the business. When the business sold goods or services to the customers on a credit basis, the debtors creates. If the debtors repay that amount, then the debtors will be cleared and it will be converted into cash to the business. If the debtors fails to repay clearly, then it will become a bad debts. If it is a doubtful that how much amount they will repay and how much amount they will not repay, so that is called as a doubtful debts. Three concept: one is a debtor, second one is a bad debts, and third one is a doubtful debts. Debts means how much amount we need to receive from the customer, it is called as a debtor. Then how much amount we will not clearly receive, that is called as a bad debts. And on how much amount there is a doubt whether we may receive or we may not receive, that is called as a doubtful debts. So now we have to pass the journal entry for this one also, provision for bad and doubtful debts. So what journal entry we need to pass is a profit and loss account debtor to provision for doubtful debts. So profit and loss account debtor to provision for doubtful debts. So we have to record it in a profit and loss account. Where to record? In the profit and loss account debit side and in the balance sheet. So from the asset side we have to record. Asset side we have to record, and from the debtor we have to subtract subsequently. So those things we will learn in the higher classes. Next, provision for discount on debtors. So this is related to the debtors, but the business will give up some amount to the debtors for a prompt repayment. So when the debtors are ready to repay the amount, then the business on its own, it will give a discount to the debtors. That is called as a provision for discount on debtors. So what journal entry we need to pass? It again, the profit and loss account debtor to provision for discount on debtors. Provision for discount on debtors. And once again we need to record it in the debit side of profit and loss account as a discount on debtors, and in the balance sheet under the asset side we have to record from the debtors we have to subtract. Next, further bad debts. So further bad debts means this is one more concept. Already some amount is treated as a bad debts during the period, that means by the end of the accounting year, once again the business will try to recover the amount from debtors. During that time, if the debtors says I am not capable of paying or I am not able to pay the amount, then it will be treated as the further bad debts. How much amount they are not able to pay, that is treated as a further bad debts. The journal entry what we need to pass is so bad debts account. Bad debts is an expenditure, so therefore so further bad debts will add up the expenditure. So therefore we have to pass a bad debts account debtor to sundry debtors account. From which account we have to subtract is from the debtors account. So therefore we have to pass the journal entry bad debts account debtor to sundry debtors account. Where to record? So we have to record it in profit and loss account in the debit side, and in the balance sheet asset side from the debtors we have to subtract. Next, manager's commission. Sometimes what happens is if the manager is a sales manager, the manager may be appointed on salary basis, that is a monthly salary basis, or on commission basis. When the managers are appointed on a commission basis, on their achievement the commission will be calculated. Either commission may be calculated after the calculations of a net profit. After calculation of net profit, there are two concepts in this calculations of a manager's commission. The commission before considering the manager's commission or after considering the manager's commission. So now journal entry is manager's commission account debtor to outstanding commission account. Manager's commission account debtor to outstanding commission account, and we have to record it in the profit and loss account in the debit side, since it is an expenditure to the business. Manager commission is an expenditure to business, that should be recorded in the debit side of profit and loss account, and it should be shown in the balance sheet under the liability side, because when we prepared the account the commission was not paid. Therefore that commission will be paid after completion of the preparation of the financial statement. That is why we have to show it in the liability side of a balance sheet. And the last one is interest on capital. So when the capital is collected from the shareholders or from the general public on repayment of interest, the interest on capital is expenses for the business. So we have to calculate interest and we have to pay the interest to the investors. So interest on capital account data to capital account, interest on capital account data to capital account, and we have to record it in the profit and loss account debit side, and we have to record it in the balance sheet. That should be add up to the capital in a balance sheet. Yes, after we came across through the adjustment, how to record the adjustment in a final accounts. So let us solve one problem on the preparation of a financial statement with all the adjustments. Okay, all of you go to the page number 431 of your accountancy textbook, practice problem 9. So practice problem serial number 9. So page number 431. So once I will go through the problem and you refer in the home. From the following balances of Mrs. Jyoti Exports, prepare a trading and profit and loss account for the year ended 31st March 2014 and balance sheet as on this date or as on that date. Here the trial balance is given and the adjustments are also given. First I will read out the debit balances of the trial balance. First one, sundry debtors 9,600, opening stock 22,800, purchases 34,800, carriage inwards rupees 450, wages rupees 1,770, office rent 820, insurance 1,440, factory rent 390, cleaning charges rupees 940, salary rupees 1,590, building worth rupees 24,000, plant and machinery 3,600, cash in hand 2,160, gas and water rupees 240, octroi rupees 60, furniture rupees 20,540 and patents rupees 10,000. Now come to the credit balances. Sundry creditors rupees 2,500, sales rupees 72,670, purchases returns rupees 2,430, bills payable 15,600, capital 42,000. The total of the trial balance is 1,35,200. And one more thing you need to notice that first you have to recheck the total of a trial balance. If the trial balance is not tallied, then your balance sheet also will not tally. So therefore, before you solve the problem, it is better to develop the habit of totaling or rechecking the total of a trial balance. Now the adjustments. So closing stock is given as usual outside the trial balance rupees 10,000. Adjustment 1. To provision for doubtful debts is to be maintained at a 5% on sundry debtors. Since we are solving the first problem on with adjustment on preparation of a financial statement, so I will give a little bit explanation how to calculate a 5% provision for doubtful debts. We have to consider the debtors amount. Debtors amount is available here in this problem is 9,600. On 9,600 we have to calculate 5%. Second adjustment, wages amounting to rupees 500 and salary amounting to rupees 350 are outstanding. These two expenses are outstanding. Outstanding means not yet paid. Third one, factory rent prepaid. Already the rent is prepaid. Depreciation charged on a plant and machinery at a 5% and building 10%. Depreciation is to be calculated and charged on the two fixed assets. One is a plant and machinery at the rate of 5% and another one is building at the rate of 10%. And the last adjustment is outstanding insurance. The insurance premium is outstanding or due for rupees 100. Okay, now let us solve the problem. So first all of you open the trading and profit and loss account. in this format, in the horizontal format. On the top of this, you write trading and profit and loss account of Mrs. Jyoti Exports on 31st March 2014, as on 31st March 2014. The left part of the trading and profit and loss account is a debit part, so therefore I have written on the left topmost corner DR, and the right part is a credit part, so therefore CR on the credit side. So it comprises of the 4 columns. So first one is a particular, second one is a amount column, third one yet again particular and amount column. Yes, you have already seen and you have learnt in the financial statement part 1. Now begin with this. The first one is opening stock. Opening stock is available in the problem, so therefore write opening stock rupees 22,800. Normally the opening stock will not pertain the adjustments, so therefore write 22,800. Next one is purchases. So purchases has got adjustment. Purchases return is there. Purchase return is there. Purchase return is also called as a return outwards. Sometimes in the problem, so return outward may also be given. So you should not get confused with that. You have to consider the return outward as also a purchase return. So purchases amount of 34,800 less returns, so 2,430. The resultant figure you have to write in the final amount column 32,370. Next part we have to write the direct expenses. So direct expenses usual item is wages. So wages amount is given 1,770. Since it has got adjustment, you have to write amount in detail column itself 1,770. Add outstanding wages. Outstanding wages rupees 500. Together you write in the final column, so 2,270. Next, carriage inward. Carriage inward means carriage means already, so we know that carriage means it is a traveling expenses or a transportation expenses. For what? For bringing the goods into the business. That is called as a carriage inwards. Carriage inward is a direct expenses that should be recorded. So in the trading account rupees 450. Next, factory rent. So factory rent has got adjustment, that is why you have to record it in the detail column. If it is only a rent, then that will appear in the profit and loss account, and it is a factory rent since it is the rent paid for a factory building, and factory is used for manufacturing of the goods. That is why that should be recorded in the trading account. Factory rent rupees 390 in the detail column, and there is a adjustment less prepaid. So rent is already paid in advance, therefore that should be subtracted rupees 100. So 390 minus 100 is equals to 290. That should be recorded in the final amount column. Next, cleaning charges. Since it is a manufacturing business, so cleaning is essential. The factory cleaning is essential. Therefore, cleaning charges is a direct expenses, that also should be recorded in trading account. Cleaning charges rupees 940. It hasn't got any adjustment. Next, gas and water. So gas and water is also used for manufacturing purpose. That is why, so that also should be recorded in the trading account rupees 240. Octroi, it is also one of the direct expenses, that also you record in trading account. Now come to the credit side. In the credit side, hardly we have got only 2 items. The one is sales, and there is no sales written here. Therefore directly you write 72,670 in the final amount column. And the closing stock is given outside the trial balance. The closing stock amount is equals to 10,000 rupees. So now as I said in financial statement part 1, so before we balance the account, we have to roughly make the total of both the side, so debit side and credit side. Which side is highest, that should be recorded in both the side. Therefore here the credit side is a more. The total is 82,670. Here also you write 82,670. Now you make the balance. Balancing is nothing but difference, finding the difference amount. How much is the total and how much amount is already existed in another side. So that is called as a balance, and balance is 23,250. This 23,250 is treated as a gross profit. Since the revenue is more than the expenses, automatically the trading account shows a gross profit, and this gross profit should be carried down to the profit and loss account. The another part of the trading and profit and loss account is a profit and loss account. From here to we have to switch on to the profit and loss account. Here the profit and loss account I have prepared. Yes, profit and loss account, first item is gross profit brought down. It is available in the trading account. So gross profit carried down 23,250, right at 23,250. Now we should be very careful before we enter each items which appears in the profit and loss account debit side. We have to go through the adjustments because majority of the expenses may have adjustment. That is why we have to go through. The first one is office rent. Office rent has not got any adjustment. Write the amount rupees 820. Next, insurance. Insurance is a indirect expenses. Insurance means insurance premium. So insurance premium rupees 1440. It has got adjustment. That is why you write it in the detail column 1440. Add outstanding insurance. It is given in the adjustment rupees 100. So together you write in the final column. So rupees 1540. Next, salary. Salary is also one of the indirect expenses. You write in the detail column because there is an adjustment for this. Salary rupees 1590, the detail column. Add outstanding salary rupees 350. So if we add it together, so it becomes 1940. You record it in the final column. Next, provision for doubtful debts. So as I have explained while explaining the adjustment and adjustment entries, the provision for doubtful debts, we have to calculate 5% on debtors. The debtors value is given in the trial balance. On the debit side of the trial balance, debtors is there. There is a sundry debtors. Amount is rupees 9,600. On this, we have to make a provision of 5%. So 5% of 9,600 is equals to 480. So that should be recorded in the final column 480. Once we have to record here and another ones in the balance sheet from the debtors, we have to subtract the same amount. Next, we have to calculate a depreciation. So depreciation, we have to calculate. The depreciation need to be calculated on two assets. One is plant and machinery. So plant and machinery value is equals to 3,600. On that 3,600, we have to make a depreciation of 5%. 5% of 3,600 is equivalent to 180. You write it in the detail column itself because so we have to club all the depreciation and we have to write only one amount in the final column. Next, depreciation on building. The value of a building is equals to 24,000 rupees. On that we have to calculate a 10%. 10% of 24,000 is equals to 2,400. So 2,400. Now make the total of these two things and you write it in the final column. Together it is a 2,580. And in the problem there are no indirect incomes. Therefore, now we have to make the total and the credit side is more here also. So the total is 23,250 and here also write 23,250 and the difference is the net profit. So amount rupees 15,890. The difference is 15,890. It is a net profit and a net profit should be transferred to capital account and that will appear in the balance sheet. We have to add the net profit to balance sheet. So now we shall move on to the preparation of a balance sheet. After completion of profit and loss account and we got the net profit of rupees 15,890. So now we shall prepare the balance sheet. So balance sheet comprises of the two sides. One is the left side, that is the liabilities and capital. Right side, assets. We have to record all the capital items. We have to record in the balance sheet. So now first one is liability side. We have to start with capital. So capital rupees 42,000. You have to record it in the inner side because it has got an adjustment. The net profit which we found in the profit and loss account, that should be transferred to balance sheet and we have to add up to the capital account. So that is why. So first is 42,000 rupees you record in the inner column. Add net profit. The net profit is brought from the profit and loss account, 15,890. So you don't get confused where is the net profit. Net profit is available in profit and loss account. So total is 57,890. You write it in the final amount column. At the beginning of the year, the capital of the business was 42,000 rupees. Now, because of the net profit, the capital rose up to 57,890 by the end of the year. Next, creditors. So, creditor is a liability. It is a current liabilities. Record 2,500 rupees in the final column. Next, bills payable. Bills payable is also current liability. So, amount is rupees 15,600. Next, we need to record the outstanding expenses. While preparing the trading and profit and loss account, I have explained to you people that all the outstanding expenses become the liability, and all the liabilities should be recorded in the balance sheet also. And in the trading and profit and loss account, we added up the outstanding expenses to the concerned expenses. Now, the first one is outstanding wages. Outstanding wages is available in the adjustment and it is available in the trading account also. Amount rupees 500. Next, outstanding salary. Outstanding salary worth rupees 350. It is also a current liability. So now you record 350 in the final column. And one more is outstanding insurance. Outstanding insurance worth rupees 100. So now come to the asset side. In the asset side, since we are following the permanence basis, so first we have to record the building. So building worth rupees 24,000 rupees, you record it in the inner column because there is a adjustment called a depreciation. So we have to subtract the depreciation from the value of a building. So 24,000 rupees less the depreciation 2,400, the resultant figure is 21,600. You have to write it in the final column, 21,600. Next, plant and machinery. So plant and machinery worth rupees 3,600 and it also has got a depreciation. So 3,600 minus that means less depreciation rupees 180. The result is 3,420. Write it in the final column. Next, we have to record other assets. Furniture. Furniture is a fixed assets and these are all tangible fixed assets. So furniture 20,540. So patent, it is an intangible asset, right? Patent rupees 10,000 rupees. Next, the current account, current assets. Current assets is the first debtors. Debtors worth rupees 9,600 and there is an adjustment for a debtors. There is a provision for doubtful debts. Provision for doubtful debts already we recorded in the profit and loss account as expenses. Now what we should do is we have to subtract the expenses, that is a provision for doubtful debts, from the debtors rupees 480. So 9,600 minus 480 is equals to 9,120. That should be recorded in the final amount column. Next, other current asset is a cash in hand. So cash in hand is rupees 2,160. That also you have to record it in the final column. One more asset, closing stock. Closing stock rupees is 10,000 rupees and factory rent prepaid. So prepaid expenses are the current assets. Prepaid expenses are the current assets and in the trading account from a factory rent we had subtracted rupees 100. Now we have to shown in the asset side as a current asset rupees 100. So now what we should do is we have to make the total. We have to make the total of both the side. So both the side total should come equal. If we solved the problem correctly, rightly, automatically the balance sheet will show the equal amount both the side. Now the balance sheet is giving us the amount of rupees 76,940 in the liabilities and capital side, and in the asset side also 76,940. If you find any difficulties, then you go through once again with this problem. Thank you.